Thank you, dear panel members, for joining this panel. Today, the topic of the conversation will be the role of public sector banks in the growth of new Aatmanirbhar Bharat. So with that, so very quickly, we have today Mr. Sanjeev Chadha, MD and CEO of Bank of Baroda. We have Mr. Mallikarjuna, MD and CEO of Punjab National Bank, and we have Mr. Ramachandran, ED of Indian Bank. So moving on to the topic very quickly, I think we have seen COVID happening. We have seen how public sector banks has really gone through ups and downs after NCLT, and now with post-COVID and all the packages, the entire focus on credit has been towards MSME and retail. So first, I would like to ask Mr. Chadha sir, what is your view in terms of the growth from here on? Means public sector banks had historically been very focused on the corporate credits. But now, do you really see that changing a lot, things moving more towards MSME and retail for public sector banks?
So I think the corporate emphasis is not going to go away entirely, particularly when we talk in terms of the revival of the economy, in terms of Aatmanirbhar Bharat. The opportunities on the corporate are going to increase. And as a general proposition, about 50% of the books of public sector banks tend to be corporate. So while there will be a secular trend in terms of the growth of retail, corporate will remain a large part of the business. And I think going forward, given the fact there's consolidation that we have seen in the public sector space, it should have a salutary impact in terms of the kind of pricing power which is there, in terms of getting the risk pricing right, which should help margins on risk mitigated basis. Having said that, there is no doubt that the structure of the economy is changing, and retail is going to become a larger and larger piece as we go forward. And if we have to write the India story, we must again have the capabilities of delivering retail, but not only delivering retail, but delivering it through channels which the current consumer is comfortable with. So I think part of the solution will therefore lie in making sure that we use this opportunity that COVID gave us by telescoping change, by making sure that all of us become used to digital ways of doing business, that how can we enable our retail distribution through digital channels, use analytics to analyze the large amount of data that we hold, and also make sure that the delivery is as smooth as possible. I think if we can do both these things, make sure that you do good quality corporate growth, make sure that you price your risk well, and also transit into retail, because that is really what is going to be holding up the future. You will have a much better balanced growth, and also growth which possibly is on par with the market.
No, absolutely, sir. I think retail is, and it's been a great growth wave for many of the private banks, and also more specifically for NBFC. Mr. Rao, how do you see for PNB Bank, again, historically corporate credit, but not only retail, but even MSME, which is becoming a key piece here, right? And especially with the Aatmanirbhar story and self-reliant India, MSME is going to play a key role. How do you see public sector banks really working with this particular segment?
No, there's no doubt about the commitment of public sector banks. If you look at even for PNB as well, our corporate book is not more than 50%. Retail MSME definitely play a critical role, but for a bank of our size like Bank of Baroda or SBI or PNB, it is the universal banking. One focus area we will have, and even the economy requires what you call funding in every sector. If you are talking about corporate, then infrastructure is very important. Recently, Honorable Finance Minister has declared a lot of measures in terms of improving the infrastructure investment. They have also brought about development financial institution a different dimension to cater to the requirement of infra lending. Since sole dependency on commercial banks may not be appropriate, as asset liability matches also will be different. So coming back to economy to be propelled in a greater growth as anticipated by everybody, it could be 21, 22, could be anything around 11 to 12%. If that kind of a growth is required, there is a scope for investment not only in corporate infrastructure, but also in retail, MSME, and otherwise. The demand which has been subdued in retail and MSME during the period of pandemic is seen to come up as a pent-up demand in the onset of festive season from October onwards. And now the demand is also holding good, though there are little variations in each sector, but there is no doubt about the demand coming up in 21-22. So the only one area where we have to see is, in spite of government coming out with tax reforms effective from 1st of October 2019, we have not seen much of an investment as of now, the reason being pandemic. Now we expect investment also in industry and services sector to come up. Thereby the opportunities for funding will be there. Recently, RBI declared that the credit growth for commercial banks was at 6.7% in the first week of January, and I am sure by March 21 it could reach up to 8%. So 21-22, if the GDP is growing at 11%, the credit growth could be anything around 12% or 15%. We'll have to wait and see how the demand is going up. But there's no doubt about the demand being visible and a lot of activity taking place in economy during 21-22.
No, absolutely, sir. Credit growth, and I think even the latest corporate results really show an upswing and an uptrend. I think the results have been really good for corporate India, and that augurs well for the banking sector. But one of the other changes and trends we definitely see is how digital is really picking up. Mr. Chadha, sir, you referred to digital, right? And how that is going to play a very crucial role, and how most of the banks are going to service its customers or even acquire its customers. Coming back to Mr. Chadha, sir, you picked up digital and did mention about it. Any specific things you really see how public sector banks are looking at digital, the kind of investments the banks would typically make in this particular area?
So I think the banks actually had started making investments sometime back, BOB in particular. So we investments in terms of again creating a data lake, all those were made in the last few years. Now I think the time has come to tie all these pieces together to make a coherent value proposition for the customers. So on the asset side, as of now, we are executing a very comprehensive digital lending project, where again, which would encompass retail, all pieces, unsecured personal loans, home loans, car loans, also MSMEs loans going forward, particularly the lower ticket ones. I think we have to understand that the lower ticket size loans are part of, you might say, the landscape. While large ticket loans will be there will be demand for low ticket loans. But if you have to do these profitably, they can only be done if they are digitally intermediated. So more and more of these loans are going to migrate to digital channels, and that's something that we are already preparing for and executing. So we would expect that as part of this project, over the next 1.5 years, almost all our retail loan underwriting would migrate to digital channels. This will bring down costs substantially. B, in terms of delivery, since a lot of this is going to be straight through processing, the delivery is going to be much better. We have seen again that a large part of this market, the small ticket market, had actually migrated to NBFCs over the last few years. Now, in some ways, we have come to an inflection point where both NBFCs and banks have to work together to address this market. Banks will do it directly also through digital lending platforms, and they could also do it through co-lending mechanisms. The Reserve Bank of India recently revised its co-lending policy, which has meant it becomes far more feasible to do co-lending with MSMEs and for personal loans. But if this needs to be done at scale, it can only be done through the intermediation of technology. So digital is going to be absolutely fundamental to risk management, and also through doing loans directly, and also acting in concert with other market players so that we can deliver these loans to the last mile consumer.
Absolutely. I think working together and working out this entire co-lending and alliance model with NBFCs is absolutely a great point, sir. So coming, Mr. Ramachandran, sir, I would like to invite you over here. How do you see the banks really, is the co-lending model really working out? Is technology the only way these problems will get resolved? Do you see any kind of hindrances coming up? Because new NBFCs, and especially the new age NBFCs, the way they are capturing some of this market, it really makes sense of both the systems really coming together, which is really going to help the economy better.
Yeah, definitely. I agree with Mr. Chadha that without technology, co-lending will be extremely difficult, because of the amount of monitoring which we need to do on these small ticket loans, which is raised by the NBFCs. And we need to maintain about 70 to 80% of the loan book on our side, and 10 to 20% will be with the NBFCs. So there is a need for an effective way of managing the things and we cannot load the core banking also on this, because it is an effort where the documentation will be joined and the accounting also will be joined. The amount which is recovered has to be apportioned accordingly to the NBFCs as well as the banks. And therefore, there is a need for a very strong technology backbone, which will enable us to monitor this effectively, and also in order to increase the scale of operations in co-lending. And that's the reason why we have not seen that when it came with the co-origination model and the co-lending model, we didn't see much of traction happening in this space. primarily because we need to set up that base where we will be in a position to quickly take up the loan details from the NBFCs and also be in a position to apportion the credits when they are received by the NBFCs. I think maybe in about a year's time, I think this technology also will mature. But on the other side, when you look at technology as a base, we have the analytics on one side, and the other one, there are certain enablers which have come in, which will enable us to look at small ticket loans purely in a digital manner, right from the point of application till the disbursement, which is going to be the game changer going forward, no? Where the NESL has come out with the digital document execution, where the e-stamping as well as the signing of documents is digital. And then banks can do the due diligence in a completely digital manner. So without having the physical person present, we can get an image of the digital image of that person as to his credit worthiness, as to his credit history. And then going forward, I think that is going to be the way forward, where people can apply for loan and also get the disbursement without having to visit a physical branch. And that I think the technology is matured, and now I think banks, public sector banks also will be taking that leap now.
Absolutely, and you can clearly see a trend of a lot of public sector banks already taking steps there. Mr. Rao, you have a housing finance company, you're a large bank. How do you see this really playing, especially from public sector banks? They typically, their returns you have seen has been quite on the lower side as compared to many private players and especially NBFCs. And that's been a big challenge. Do you see this being a good answer for bringing profitability at a very good level in public sector banks, both the entire MSME retail story as well as the technology part?
See, if you look at housing finance companies, while the disadvantage with them is interest rate, but the advantage is last mile connect with the customer and early turnaround time. That is quick turnaround time. These are the two factors whereupon they are able to compete with the public sector space, even in housing finance. So housing finance companies across the country had little amount of stress in terms of the investment in real estate, which they have done. That is the reason why probably we have seen not only PNB Housing Finance, many of the housing finance companies, but then that has been passed. They have come out of that problem. There is a good piece available for them to do the business in housing finance, in spite of the fact that their interest rates are a little higher than that. But that piece is available. Now, this additional advantage for them is they can tie up with various banks for the co-lending, though they cannot do with PNB because we are the parent there, but they can do with various other banks in terms of co-lending. That is one additional option for them. The hybrid rate can still be much better for the customer, though it will be a little higher than what public sector offers, but it will definitely be lower than what the housing finance companies give. So the kind of impetus what we have seen currently after a pandemic in the housing finance as well. So I'm expecting that housing finance companies also will do well in the days to come, while public sector will have its own area with respect to increasing the housing loans.
But sir, on the point on increasing returns for public sector banks, how do you see really an MSME play and technology play? As you put it, a good part, and Mr. Chadha also mentioned, still a good part of the balance sheet will be corporate credit. But the returns on the lending side, which and NBFCs have seen, has been more on the retail side. Of course, banks have really been the great support for building the entire infrastructure story and even for corporate credit. So how do you see that playing out from a profitability perspective for public sector banks?
See, if you look at in the last almost a year, on the onset of pandemic, the RBI has reduced the repo rate by 115 basis points. So it has impacted both the sides, liabilities as well as assets. The savings rates also have come down, term deposit rates also have come down, lending rates also have come down. More or less, repo linkage is given to all retail and MSME advances. And corporate also, as you know, the pressure is always there for offering at a lower price. And in the recent times, because of high liquidity available, we had to give at a very, very low rate, even linked with GSEP price or treasury bills. So nevertheless, if you have observed the results declared in many of the public sector banks, the NIM was not impacted very badly. If you have seen the NIM, even in our bank, when we declared recently, it was 3.09. So holding on to the NIM between 2.75 to 3.25 in the range of in that range, I'm not seeing as a challenge. But what we require is, in the process, we need to enhance the efficiency to drive towards digitalization, so that you can hold on to the NIMs more effectively by reducing the service cost. So as Mr. Chadha rightly said, in terms of personal loans particularly, where end-to-end digitalization is possible without any manual intervention, there you can lend more in the number. Critical mass may not be very high, but service cost will be very lower. because it can be delivered immediately to the customer and only collections have to happen over a period of time, and majority of the customers are data is available with the bank. So most of the banks are doing that. Even public sector space is also in that direction. So it is a balancing the entire portfolio in terms of how we are using our service cost for delivery, and that kind of balancing the portfolio will give us advantage for retaining the NIMs and earn. This kind of a situation is going to remain. You can't expect to charge a higher loan interest rates because the market is like that unless the repo rate moves up, which we do not expect at this point of time. So the current NIMs between 2.75 to 3.25 appear to be healthy if we are able to maintain consistently.
Absolutely. And in fact, you're right. So the cost of delivery really gets managed with getting technology in. But the other big element also, which had been a bit of a problem child for public sector banks, was the high NPA levels. And in fact, the latest financial stability report does indicate that potentially the gross NPAs may go up because of the pandemic impact, and especially MSME or retail sector may get impacted. Mr. Chadha, there again, any thoughts, any views? The corporate results has been great. Do we really see the NPAs going up because of the pandemic impact, or it should be okay for corporate India?
So I think as far as corporate lending is concerned, even if we look at what was the scenario before COVID came, we had seen 3 or 4 years of high stress, and whoever was left standing post those 3 or 4 years had reasonable resilience, which is why we have seen that even on account of COVID, the impact has been less as compared to what was anticipated, simply because corporates had built a very high degree of resilience. Now, along with that, the recovery has been much sharper as compared to how any of us had anticipated. So that's number two. Number three, I think the regulators have made available the means to mitigate whatever stress that might have come about even after this. So there was the restructuring option which was made available, and to the extent it was necessary, it has been used. But the fact again that the restructuring has come down at a far lower level as compared to what we again anticipated at the beginning would seem to suggest that as compared to the previous prognosis, corporate stress has been less. So going ahead also, I would believe that particularly when it comes to large corporates, we should see a very significant improvement going ahead and a reduction in credit costs. I think this is pretty much borne by our experience over the last 12 months and also the corporate results that we have been seeing.
And Mr. Ramachandran, your views, especially on the credit cost coming towards MSME and retail. I think you also have gone through a large merger as well.
Primarily, no. As far as Indian Bank was concerned, it was very low on the corporate lending. There was not much of this thing for the last maybe 4 or 5 years. But then with the amalgamation of Allahabad Bank and getting a pan-India presence, and there are a lot of corporates which have come in from the Allahabad Bank side also into Indian Bank. And Indian Bank had traditionally in the southern part of the country, a few of the major corporates over there. Now the focus is now trying to shift towards corporate lending also. There is an impetus given to see that the corporate lending is also improved. And with some of the support coming in from the government side and in terms of infrastructure creation, in terms of roads, HAMs, solar, these are, we find that it's more into some 3 or 4 pockets where this lending is happening, which we wanted to be more broad-based, primarily into capacity expansion and in terms of other enterprises coming up. But on the MSME and the retail side, we have been growing healthily, and it's about 11% growth year on year on the MSME. And the NPA is also fairly contained. It's just about 8 to 9%. And I think with the pandemic also coming down, we find that we feel that it will definitely revive. And the support which has come from the government also has helped us in terms of GECLS, that CGSSD and all that. So we have been aggressive on that front to support the corporate, support the MSMEs. Retail has been slightly muted, I would say, in terms of when compared to the industry level. But we are now trying to find out how we can step up, because there was a process change which we brought about after the amalgamation. So that has to get roots, and then that will also pave the way for increased retail lending, which will support the pricing part of it, to protect the NIM. And some of the new products, like we have given a focus on the startups, where we've tied up with IIT Madras and now with the Indian Institute of Science, Bangalore. So we are trying to see that we are able to grow in that area as well, so that we will be in a position to protect our lending to the MSMEs as well as the balance is about 54% on the retail and MSME and 46% on the corporate book.
No, great, sir. In fact, it's really heartening to know that, probably the confidence is there that NPL levels will be under control for across corporate credit as well as for MSMEs and retail as well. But the recent budget has also, the government has come up with this entire concept of bad bank. Mr. Rao, what do you think about the entire concept of bad bank, number one? And number two, do you think it should help solve the entire, NPA issues which public sector bank had and was a big growth impediment, right? They were really challenges to growth because of the NPAs. Do you think a bad bank will really help that?
The announcement by the Government of India by the Honorable Finance Minister regarding ARC AMC is a welcome decision. In fact, this issue has been in the discussion in public domain for quite some time. Even at IBA level, we had discussed and we have recommended to RBI as well as Government of India. There's no doubt about its utility. There are quite a few operational issues currently when other ARCs are taking the assets through bidding, because many of the banks, more than 4 or 5 banks will be in the consortium lending when they are funded to an asset. In order to ARC to take that asset under a transparent process of bidding, all the banks have to go for bidding, then only it can happen. So there is an operational issue, number one. Number two, there has been an accumulation of NPA over a period of time. It's even more than 6 trillion to 7 trillion currently across the banking industry, where we definitely need a one-time measure to hive off that and go for a proper way of disposing that through transparent process. As we have seen in the last 3-4 years, when IBC has come, more than 4 trillion has been resolved in terms of debt, even though the extraction is around 45 to 46%. The fundamental point is the market has matured, whereupon there are parties, there are avenues for the people to purchase the ongoing asset, whether for continuation of the same by additional lending or even liquidation process. So some element of maturity has come, as a result of which we expect that many of these assets can be sold in a transparent process through bidding. If that has to be hazard, there is a requirement of aggregation of this debt from various members of the consortium. And once it is aggregated, the process will be smooth. It was in this context that we had also recommended on behalf of IBA to RBI and Government of India. That is the reason why Honorable Finance Minister has declared that. I see that in next few days' time, the modalities will be finalized. I don't have any doubt with respect to its utility. Very shortly, between 6 to 12 months' time, this ARC AMC concept should get maturity in terms of aggregation of assets, because when we transfer, it will be only an aggregation at net book value. Only ultimately through the bidding process from ARC, it will be purchased by the party. This will give good amount of balance sheet cleaning for the public sector, and you have a visibility with respect to requirement of capital adequacy with the profile available at our bank. So it is a good move. I'm sure it will do wonders in the days to come, particularly for the accumulation of roughly around 6 to 7 trillion NPA profile currently we are carrying.
That should help public sector banks' balance sheet also get much more lighter and easier in terms of its flexibility to operate and give further corporate credit. Mr. Chadha, with this entire concept of the AMC coming in on the bad bank side, you've seen post the NCLT a lot of stressed asset funds have really shown great interest in acquiring some of the situations. Do you think this bad bank situation is going to be a great news for some of the stressed asset funds, or even for the other corporate India to do great acquisitions and good turnaround stories really coming out of this?
So I would believe yes. I think, as Mr. Rao mentioned, the primary benefit of this particular initiative is the aggregation of NPAs. Now, anybody who wanted to acquire a controlling interest, I think that was the biggest challenge. How do you make sure that A, the process is speedy? 2, how do you make sure that all the different stakeholders, they can act in tandem? I think the fact that this particular device should ensure aggregation and make sure that whoever is the counterparty, whether it is a stressed asset fund or anybody else, I think if they are able to speak to one entity and make sure that decision making is fast, it can have a tremendous impact in not only unlocking value for banks themselves, but also if you look at again the amount of capital that is stuck, the amount of assets which are as of now yielding suboptimal returns, it can actually have a very, very salutary impact going forward. Also, I think in terms of overall improving the quality of the investment climate, it should be a big help, because you are sure that look, decisions will always go wrong. Entrepreneurs are in the business of taking risk, but the fact is it should be possible both for banks as well as for entrepreneurs to unwind their position in an expeditious manner. And I think this is one instrument that should be able to improve the climate overall and have a big impact going forward.
Absolutely, sir. And probably, sir, two words you used, unlocking value. And I think that's really important, because if you actually today see the market capitalization and the valuation which is given by the market public sector banks is typically less than 1x of price to book. And with all those initiatives, Mr. Ramachandran, sir, what's your view? Do you see with the credit growth coming back, NPS situations getting resolved, retail MSME getting back to focus, and technology helping reduce cost? Where do you see market's perception on the value of public sector banks?
No, definitely. I think the bad bank concept, no, it's strong on intent, but little on details, I would say, because we don't know the capital structure, what is the type of organization which is going to head it. Because we have experimented the ARC model, and we need to see that we are able to hive off these bad debts, like Mr. Rao was telling, so that we can unlock the capital and give it for productive use when the economy is rebounding, so that the banks are not constrained for lending. And also it will help in the resurrecting the economy, as well as also improving the credit portfolio of the banks. It should not be just the transfer of bad assets to another bad bank, but it should be that we are improving the appraisal skills, and then there the digital will come into play, where it will be completely a methodology which will be used, where we will be more transparent and we will be in a position to assess the balance sheet or the other criteria of the organizations which are coming in, which will going forward. No, we're learning the lessons for the last 4-5 years, which will help us to bring in a credit discipline, as well as also build a healthy book, and that would in turn propel the value of the public sector banks in the minds of the, and some of the QIPs and the issues which are coming into the market also we have seen favorable results. That itself shows that the market is open for investment in public sector. And with the bad assets removed, I think definitely it will help us to unlock the value, definitely.
Oh, great, sir. Mr. Rao, what's your view there again with two banks, in addition to IDBI Bank really coming up on the divestment theme? How do you really see public sector banks trying to improve the market's perception on this particular segment, right? At least in my view, it definitely needs an upgrade. But what's your view, sir?
No, and see, if you have seen in the recent times, there has been a good amount of interest in the market towards the public sector space. See, whatever has happened over a period of time ever since the asset quality review came, which was an offshoot of lending in infrastructure, happened during the year 2007 to 2012. Majority of the reasons for external factors, either in road segment or steel segment, while that has been a past, banks have done extremely well during the year 1920 and 2021 in terms of showing profits in the public sector space. So this has brought back some element of confidence in the market, which can be seen by the fact that many of the public sector banks have gone to the market either for AT1 bonds, Tier 2 bonds, or QIP, and some of the banks are lined up in that activity. Probably they are looking for good amount of value in the years to come for the public sector space, maybe 1 year, 2 years horizon. The other important factor is now, because of post-pandemic anticipation of growth in GDP, and also the finance minister's declaration with respect to investment in infrastructure, the role of banks is going to be more clearly defined in the days to come in terms of lending. So these are all the avenues which appear and which show good amount of improvement in the balance sheets of the banks, as well as their performance in the days to come. So there is a positive sentiment towards the public sector space. Now, in terms of government reducing the stake or privatizing, it is just a matter of what you call important thing. If you look at Narasimhan Committee way back in 91-92 itself has recommended to have only few banks in the public sector space or in a larger what you call gamut of size, and some of them at the regional level, which was reiterated again by the PGNI committee recommendations. So even though it has taken longer duration of time, probably because of policy consistency or even the ecosystem to be conducive, whatever may be the reason, but it is a welcome decision by Government of India. First of all, to reduce their stake as much as possible in the bank's public sector space, so that good amount of retail PCs available in the market. If I want to give an example of PNB, we had 85.5 stake from Government of India, which was reduced to 76.9 now. And in the recent times, we have seen large amount of volume being traded in the market, which is a very important thing. When the trading becomes high, the reflection of the price also will be there, commensurate with the performance of the bank. So I see that there will be good movement in the next year in terms of the interest towards the public sector space in the market.
No, absolutely, sir. I think it's long due now, especially with the performance and the results you actually see of many of the public sector banks. Mr. Chadha, sir, one question to you. I think you've seen the merger of banks and especially Bank of Baroda. You also recently announced that the merger is complete now. And with the divestment program happening in, any tips, we don't know which are the two banks which are going to get divested, but any particular tips you would like to leave to public sector banks or to the market in terms of what are the 2-3 core things which people need to see when you're really looking at divestments for the banks?
So I think now this is a question which, again, very frankly, I'm not competent to answer. But again, when it comes to amalgamation, I think there are a few things that which are lessons for us. I think any change is a great opportunity to do things which may not have been possible earlier. I think amalgamation was one opportunity which was there, and BOB and I'm sure the public sector banks have capitalized on it completely to make sure that even while we amalgamate the banks, we also set them for the future. And I think COVID also has been a similar kind of opportunity where it has opened up horizons, telescope change, and make sure that the banks actually have an idea in terms of what is the world going forward. So I think it's important for us that we make the investments and we reposition our banks post-amalgamation, post-COVID for the future. And the sanitary impact, again, is something which is on account of two reasons. With the amalgamation, the number of public sector banks has come down. So rather than, again, having 10, 12, 15 Me Too kind of institutions where differentiation is not possible, now it will be possible for us to make sure that the value proposition that public sector banks present, that can be clearly brought out and presented to the investors. Two, it also gives us an opportunity, again, to make sure that post-privatization, when again the numbers come down, the banks which are there, they can become larger, more credible, and much more vibrant entities which can help shape the future. I don't believe there's going to be a time when public sector banks are not going to be an important part of the landscape because they fulfill a very large and important requirement, on the side of corporate lending, which they continue to dominate, B, in terms of financial inclusion. But going ahead, if we can marry that relevance of being large corporate lenders and being bankers to every Indian, along with positioning ourselves as agile players who can contribute as much to the digital space, I think there's a role of public sector banks going ahead in the future, which is as important as it was in the past.
Well, thank you, sir. I think you superbly summarized. In fact, I was going to ask you, sir, any final comments from your side, and you actually made a nice summarized way of comments. Mr. Rao, any final comments from your side?
See, a very simple revival of economy is the objective of every stakeholder in the country, and banks have a very important role. And out of the public sector banks have very, very critical role to play in the year to come. So we all are gearing up for the improvement in the economy, and we'll be seeing the opportunity to come forward.
Mr. Ramachandran, your final comments.
It's primarily now, one is that the consolidation. The second one, the consolidation helped us to bring about process changes. And the third one is now we are on the cusp of the digital wave. And since we have consolidated, it's a high time that we can take this wave right as it is, so that we will be in a position to position public sector banks also as nimble participants in the market space, which will help us going forward in the next decade. The last decade was the core banking, and this decade will be the digital space.
So thank you, sir. Thank you, everyone. Each one of you for providing your comments. I think it was a great discussion. I think it's clearly public sector banks are going to play a very important role. And now with the focus on few banks and the differentiation you can really create, I think you all are there on the verge of really going through a very, very strong growth journey. So, sir, thank you very much, and thank you for your time.
Thank you.
Thank you. Yeah, thank you.